Welcome. The BoreCore archive is a collection of slow, methodical recordings of technical processes and perfectly boring routines designed to help you relax and fall asleep. New procedures are added regularly, so don't forget to like and subscribe. Time to relax, close your eyes, and take it on down to Sleepy Town.
Welcome to a complete operational guide to the daily practice of actuarial science, including mortality modeling, insurance pricing, pension valuation, reserving, and the writing of opinions that no one reads until something goes wrong, or putting a number on the probability that something bad will happen for money. You are an actuary. This is a job title that most people recognize and almost no one can define. If asked at a party what you do, you have several responses available depending on how much time you have and how much you wish to invest in the conversation. The shortest response is, I use mathematics to assess financial risk. The medium response is, I work in insurance, figuring out how much things should cost based on how likely bad things are to happen. The longest response is what we are doing now, and it takes approximately 2 hours. The word actuary comes from the Latin actuarius, a term used in ancient Rome for a clerk who maintained public records, particularly records of transactions and events. The modern actuarial profession bears a specific relationship to this origin. You maintain, in a rigorous quantitative sense, the record of what has happened in the past in order to make defensible statements about what is likely to happen in the future. The past is data. The future is probability. Your job is the translation between them. You work for a mid-sized life insurance company, which is the context we will use for most of this script, though we will also touch on the other major areas of actuarial practice: property and casualty insurance, pension consulting, and health insurance. Life insurance actuarial work is among the oldest and most developed branches of the profession. The mathematics of life contingencies, as it is formally called, has been evolving since the 17th century, when Edmund Halley, the astronomer for whom the comet is named, published the first reasonably accurate life table based on mortality data from the city of Breslau. You are working in a tradition that is more than 300 years old. This does not come up often in meetings, but it is occasionally useful as context when a non-actuary suggests that your methods are overly conservative or insufficiently modern. Your formal credentials are the Fellowship of the Society of Actuaries, abbreviated FSA, which required passing a series of examinations over a period of approximately 7 years, and the Chartered Enterprise Risk Analyst designation. The examination process for actuarial fellowship is one of the more demanding professional credentialing programs in any field. Each exam covers a substantial body of mathematics, statistics, finance, economics, and domain-specific theory, and the pass rate for most exams is between 35 and 55%. The exams are taken over years because they are too numerous and too demanding to take over months. By the time you passed your final exam, you had spent more time studying for actuarial exams than you had spent in your undergraduate degree. This is not unusual. Today is a Tuesday in early spring. You have several projects in progress. The most pressing is a review of the company's life insurance pricing assumptions, which is scheduled to be completed by the end of the month. You also have a mortality study in progress, a reserving calculation due on Friday, and a meeting with the product development team at 2 in the afternoon to discuss a new insurance product they want to launch in the third quarter. You also have 3 emails that require substantive responses, a stack of actuarial literature you have been meaning to read, and a question from a colleague about stochastic modeling that you need to think about before answering. This is a typical day. You begin. Before describing the day's work in detail, it is worth establishing what actuarial work is at the level of first principles, because the answer is less obvious than the party description suggests. Actuarial work is, at its core, the management of financial risk through quantitative analysis. Risk, in the actuarial sense, is the possibility that future outcomes will differ from expected outcomes in ways that have financial consequences. An insurance company that sells life insurance policies is exposed to the risk that policyholders die sooner than expected, causing the company to pay death benefits earlier and in greater numbers than it priced for. A pension fund is exposed to the risk that its members live longer than expected, causing the fund to pay pensions for more years than it planned for. A property insurer is exposed to the risk that a hurricane season is worse than the historical average, causing claims to exceed the premium collected. In each case, someone must quantify the risk, determine how much money should be set aside to cover it, and determine what to charge the customer for accepting it. That someone is you. The quantification of risk requires 2 things: data and a model. Data is the historical record of what has happened. How many people of a given age died in a given year? How many houses burned down per 1,000 insured? How many car accidents occurred per million miles driven? The model is the mathematical framework that transforms the data into statements about the future. Given that X% of people aged 65 died last year, what is the probability that a specific 65-year-old will die in the next year? And how should that probability change as they get older? The model must be fitted to the data, validated against independent data, stress tested against scenarios outside the historical range, and periodically updated as new data accumulates. You do all of these things. The translation of risk quantification into financial decisions requires additional layers. You must determine not just the expected cost of future claims, but the uncertainty around that expectation, the range of outcomes that could plausibly occur, and the probability of each. You must determine how much capital should be held as a buffer against worse than expected outcomes. You must determine how the financial results of the company should be reported given the inherent uncertainty in future claim costs. And you must communicate all of this to people who are not actuaries, executives, accountants, regulators, and occasionally lawyers, in terms they can understand and on which they can base decisions. Communication is a larger part of actuarial work than most people expect. You open your laptop and begin the day. The first task of the morning is reviewing the progress of the mortality study. A mortality study is an analysis of the actual death rates experienced by a company's policyholders, compared against the expected death rates implied by the mortality assumptions used in the company's pricing and reserving. It is one of the foundational tasks of life insurance actuarial work, because the mortality assumption is the single most important assumption in the pricing of a life insurance product. And if the actual mortality differs materially from the assumed mortality, the financial results of the company are affected. You open the mortality study spreadsheet, which is a large and carefully organized file containing several years of policyholder data. Each row represents a policy year, 1 year of exposure for one policy, beginning at the policy anniversary date. For each row, the data includes the policyholder's age at the start of the year, their sex, the amount of insurance, the policy type, whether the policyholder died during that year, and several other variables that may be relevant to mortality experience. The study currently covers 5 years of data and approximately 240,000 policy years of exposure. The central calculation in a mortality study is the actual to expected ratio. Abbreviated ATWE, the ATWE ratio compares the number of deaths that actually occurred in the study data against the number of deaths that would have been expected based on the mortality table being studied. A ratio of 100% means actual experience exactly matched the expected table. A ratio above 100% means actual deaths exceeded expectations, which for a life insurer is adverse experience. The company paid more death benefits than it expected to. A ratio below 100% means actual deaths were below expectations, which is favorable. You review the current ATWE results. The overall ATWE ratio across all ages and policy types is 93%, meaning actual deaths were 7% below the expected table. This is a favorable result. However, the overall ratio conceals important variation by age and policy type, and the variation is what makes the study useful. You scroll through the results by age band. For ages 20 to 39, the ATWE ratio is 81%, substantially below expectations. This is expected. The standard industry mortality tables used as the expected basis for this study are derived from population data and from broad industry experience, and your company has historically targeted a younger, healthier demographic in this age range through its underwriting practices. Better underwriting produces better mortality experience. 81% for ages 20 to 39, is consistent with the company's underwriting philosophy and with the results of prior mortality studies. For ages 40 to 59, the A/E ratio is 91%, also favorable, also consistent with prior experience. For ages 60 to 69, the ratio is 98%, closer to the expected table, as is typical for older ages where the mortality rates are higher and individual variation is less pronounced. For ages 70 to 79, the ratio is 107%, higher than expected. You examine the age 70 to 79 results more carefully. A ratio of 107% is not alarming in isolation. In a study of this size, a ratio of 107% might be within the range of random variation. But this is the third consecutive year in which the 70 to 79 age band has shown adverse experience, and the trend is worth examining. You run a statistical significance test on the excess deaths in this age band. The test asks, if the true underlying mortality rate is exactly what the expected table says it is, how likely is it that we would observe a ratio of 107% or higher over 3 years by chance alone? The answer is a p-value of 0.03, meaning there is approximately a 3% probability of observing this result by chance if the table is correct. 3% is below the conventional significance threshold of 5%. The excess mortality in the 70 to 79 age band is statistically significant. Note this finding and add it to the mortality study report in progress. The finding has several possible explanations. The company's products in this age range may have attracted a less healthy population than the standard table reflects. The standard table may itself be slightly low for current mortality experience in this age range. There may be a specific policy type or distribution channel that is performing differently from the rest of the portfolio. You will investigate each possibility. For now, you note the finding, flag it for follow-up analysis, and move on to the rest of the morning's work. The mortality study, when complete, will be used to calibrate the mortality assumptions in the company's pricing models and its reserving calculations. If the study confirms that the company's actual experience is consistently better than the standard table at most ages, the pricing assumptions may be adjusted to reflect this, which would allow the company to offer more competitive premiums. If the adverse experience in the older age band is confirmed as a genuine trend rather than random variation, the assumptions in that age range may need to be strengthened, meaning the company would hold more conservative mortality assumptions, and as a result, price that segment of business more cautiously. These are the decisions that flow from a mortality study. They are not made by you alone. You provide the analysis and the recommendation, and the decisions are made by the pricing committee. Your role is to ensure that the analysis is correct and that the recommendations are defensible. To understand the mortality study fully, it is necessary to understand what a mortality table is and how it is constructed, because the mortality table is the central actuarial tool for working with human lifetimes, and its construction is one of the most methodologically rich areas of actuarial practice. A mortality table, also called a life table, is a mathematical construct that describes the probability of death at each age for a defined population. The most basic form of the life table consists of two columns, age and QX, where QX is the probability that a person alive at exact age will die before reaching exact age plus 1. So Q50 is the probability that a person alive on their 50th birthday will die before their 51st birthday. For a healthy adult population in a developed country, this probability is typically somewhere between 1 in 500 and 1 in 300, meaning roughly 2 to 3 deaths per 1,000 people alive at age 50 in a given year. From QX, the rest of the life table can be derived. Starting with a hypothetical cohort of 100,000 people alive at age 0, called the radix of the table, you can calculate how many will survive to each subsequent age by applying the QX values sequentially. The number surviving to age is called LX, the number dying between age X and age. Plus 1 is DX, which equals LX multiplied by QX, dividing D by the total deaths across all ages, gives the probability that a randomly selected death from the cohort occurred at age X, summing the expected remaining lifetime at each age, gives the life expectancy at that age, which is one of the most commonly reported statistics derived from a life table. Life expectancy at birth for men in the United States is currently approximately 74 years, and for women, approximately 79 years. These figures come from life tables published by the National Center for Health Statistics, which constructs period life tables annually from death registration data and census population estimates. A period life table describes the mortality experience of a population in a single calendar year, applying the age-specific death rates observed in that year across a hypothetical cohort. A cohort life table, by contrast, follows an actual birth cohort from birth to extinction and uses the actual mortality rates experienced by that cohort as it ages through time. Cohort life tables are more theoretically accurate, but require waiting for the cohort to die, which is impractical for current projections. Period life tables are used for most practical purposes. For insurance and pension work, the relevant question is not the current mortality rate, but the expected future mortality rate. How likely is a person who is currently 50 years old to die at age 70, given that mortality rates may change between now and then? Answering this question requires mortality improvement factors, which are assumptions about how mortality rates will change over time. In most developed countries, mortality rates have been declining steadily for most of the past century, driven by improvements in medical care, nutrition, sanitation, and living standards. The annual rate of mortality improvement, expressed as the percentage reduction in QX per year has averaged approximately 1 to 2% per year across most adult ages in the United States over recent decades, projecting future mortality using improvement factors introduces substantial uncertainty. The improvement factors have not been constant. Improvements were rapid in the mid-20th century, driven by declines in cardiovascular mortality, slowed in the 1980s and 1990s, accelerated again in the early 2000s, and then showed signs of stalling or revering in the 2010s in some age groups, potentially due to the opioid epidemic, rising obesity rates, and other public health trends. For a life insurer selling products with obligations extending 30, 40, or 50 years into the future, the choice of mortality improvement assumption is highly consequential. A product priced with conservative, slower improvement assumptions will be profitable if mortality improves slowly. A product priced with aggressive improvement assumptions will be profitable only if mortality improves at the assumed rate. If mortality improves faster than assumed, the insurer pays claims for longer than planned. You work with two separate contexts for mortality improvement: pricing, where you need assumptions that are appropriate for setting premiums, and reserving, where you need assumptions that represent a best estimate or a prudent estimate of future obligations. We will return to reserving later in the day. For now, you note the mortality study findings in the study report, run the supplementary analyses you identified, and close the file with a note to complete the write-up tomorrow. You open the pricing review project. The pricing review is a systematic examination of the assumptions and methods used to set premiums for the company's life insurance products. It is performed annually in preparation for the following year's product offering, and it requires reviewing each assumption category in turn: mortality, lapse, investment return, expenses, and taxes. Insurance pricing, at its most fundamental, is an application of the principle of equivalence. The premium charged for a policy should be actuarially equivalent to the expected benefits paid under that policy, adjusted for the time value of money, the cost of holding capital, the company's expenses, and a margin for profit and adverse deviation. This principle sounds simple and is, in practice, the subject of considerable complexity. You are reviewing the pricing for a term life insurance product. Term life insurance is the simplest form of life insurance. You pay a fixed premium for a fixed period of years, and if you die during that period, your beneficiary receives the death benefit. If you survive to the end of the term, the coverage ends and nothing is paid. It is insurance in the purest sense. You are buying protection against a risk, and if the risk does not materialize, you receive nothing. This is not a feature that all insurance customers find intuitive, which is why term life insurance is often compared, by people explaining it, to car insurance, which most people understand. You pay for it, and if you have no accidents, you do not get your money back. The comparison is imperfect, but directionally correct. The premium for a term life policy is calculated as the present value of expected future benefits divided by the present value of expected future premiums, with adjustments for expenses and profit margin. Expected future benefits means the death benefit amount multiplied by the probability of dying in each future year. Expected future premiums means the premium amount multiplied by the probability of surviving and remaining in force in each future year. Both sequences of expected values are discounted to the present at the assumed investment return rate. Because $1 paid in 10 years is worth less than $1 paid today, the lapse assumption is the probability that a policyholder will voluntarily terminate their policy before the end of the term by stopping premium payments. Lapses reduce the insurer's future obligations because a lapsed policy no longer requires a death benefit to be paid, but they also reduce future premium income. The net effect of lapses on pricing depends on when they occur and on the relationship between the mortality of lapsing policyholders and the mortality of those who remain. If high mortality policyholders are more likely to lapse, the remaining in force block will have better mortality, which is favorable for the insurer. If low mortality policyholders are more likely to lapse, perhaps because they have found cheaper coverage elsewhere, the remaining block will have worse mortality, which is unfavorable. This is the phenomenon known as anti-selection or adverse selection, and managing it through pricing, underwriting, and product design is a central challenge of life insurance actuarial work. You review the current lapse assumption, 8% in year 1, declining to 4% in year 5 and thereafter for a standard 10-year term product. You compare this against the company's actual lapse experience from the past 5 years, which shows an overall lapse rate of 6.8% in year 1 and 3.6% in year 5. The assumed lapse rates are modestly higher than actual experience, assuming higher lapses than actually occur means the pricing model assumed more policies would terminate, reducing both the assumed benefit payments and the assumed premium income. The net effect on pricing of a slight overestimate in lapse rates is small and in the conservative direction for the company. You note the comparison and recommend a modest revision to the year 1 lapse assumption to better reflect recent experience. The investment return assumption is the rate of return the company expects to earn on the assets backing the insurance liabilities. For a term life product, which has no savings component, the investment return affects pricing primarily through the discount rate used to calculate present values. A higher investment return assumption reduces the present value of future benefits, which reduces the required premium. The current assumption is a net investment return of 4% per annum, reflecting the expected yield on the company's fixed income investment portfolio after deducting investment expenses. You review the current portfolio yield against the most recent investment report and confirm that 4% remains a reasonable assumption in the current interest rate environment. You note this. The expense assumption covers the cost of issuing and administering the policy. The underwriting costs to evaluate the applicant's health and insurability, the administrative costs to maintain the policy records and process premium payments, and the claims costs when a death benefit is paid. Expense assumptions are typically expressed as a combination of a per policy amount and a percentage of the death benefit amount. The current expense assumption is $42 per policy per year for administration, plus $28 per policy per year for maintenance, plus a claims processing cost of $150 per claim. You compare these against the company's most recent expense study, which is a detailed analysis of the company's actual operating expenses allocated to each product line. The expense study was completed 6 months ago. The per policy administrative expense has increased slightly due to a technology platform migration. And you note a revision to the assumption is warranted. The pricing work leads naturally to a consideration of underwriting, which is the process by which an insurance company evaluates individual applications and decides whether to offer coverage and at what price. Underwriting is not typically the actuary's day-to-day responsibility, which belongs to the underwriters, but the actuary and the underwriting department are closely connected. The actuary designs the risk classification system that determines how applicants are evaluated, and the mortality study that measures whether the underwriting is working. Life insurance underwriting for individual policies involves collecting information about the applicant that is relevant to their mortality risk: age, sex, smoking status, health history, family health history, occupation, and in many cases the results of a medical examination, including blood work. This information is used to classify the applicant into a risk class that determines the premium they are offered. The standard risk classes are preferred best, preferred, standard plus, standard, and substandard, with substandard policies sometimes subdivided into table ratings that specify a multiple of the standard rate. The risk classification system is designed based on actuarial analysis of the relationship between underwriting factors and subsequent mortality. The fact that smokers have higher mortality than non-smokers, and therefore pay higher premiums, is an actuarial determination, supported by both epidemiological evidence and the company's own experience data. The fact that applicants with a history of certain medical conditions are rated substandard, meaning they pay a higher premium, reflects the actuarial assessment of how those conditions affect mortality risk. The rating factors used in life insurance underwriting are the product of decades of mortality research and are periodically updated as new evidence accumulates. Accelerated underwriting is a relatively recent development that uses data from sources outside the traditional medical examination to assess mortality risk. These sources include prescription drug databases, which reveal what medications an applicant is taking, motor vehicle records, which reveal driving history, and consumer data aggregators, which compile information about lifestyle factors correlated with health. The actuarial challenge of accelerated underwriting is validating that these data sources provide sufficient risk discrimination to replace or supplement the traditional medical examination without introducing biases that systematically disadvantage certain demographic groups. This is an active area of actuarial research, and you have been following developments in the literature. The connection between underwriting and the mortality study results you reviewed this morning is direct. The adverse mortality experience in the 70 to 79 age band may reflect a weakness in the underwriting process for applicants in that age range, or it may reflect the fact that the company writes a type of policy that attracts applicants with below average health at those ages, or it may reflect a change in the health of the general population in that age range. Distinguishing between these explanations requires additional analysis. Examining the mortality by policy type, by distribution channel, by underwriting class, and by calendar year. This is the work of the mortality study, and it is the work that will occupy several more sessions before the study is complete. You open the reserving model. The reserving calculation is due on Friday, and while the model is well established and the calculation is largely automated, you review the inputs and the outputs carefully before finalizing any reserve figures. Because reserves are financial liabilities on the company's balance sheet, and their accuracy is subject to regulatory review and audit. Reserves in life insurance are the amounts that the company must hold today to meet its future obligations to policyholders. They represent the company's best estimate, or in some contexts, a prudent estimate of the present value of all future benefits it will pay, net of the present value of all future premiums it expects to collect. A company with more reserves than it actually needs is holding capital unproductively. A company with insufficient reserves is understating its liabilities and potentially misrepresenting its financial position. The actuary's role in reserving is to calculate the correct amount, document the methods and assumptions used, and provide a professional opinion on the adequacy of the reserves. In the United States, life insurance reserves are calculated and reported under two parallel frameworks, each with different purposes. Statutory reserves are calculated under rules specified by the National Association of Insurance Commissioners, NAIC, and are reported to state insurance regulators. They are generally calculated on prescribed, conservative bases and are intended to ensure that the company can meet its obligations under adverse conditions. GAAP reserves are calculated under generally accepted accounting principles, the accounting standards applicable to publicly traded companies, and are intended to reflect a more economically realistic estimate of the company's obligations for financial reporting to investors. A company reports both sets of reserves, often with material differences between them, and the differences are explained in financial disclosures. Managing both sets of reserve calculations is part of your quarterly workflow. The reserve for a term life insurance policy is conceptually simple. It is the present value of expected future death benefits minus the present value of expected future premiums, where both are calculated using the policy's mortality, lapse, and interest assumptions. For a newly issued term policy with level premiums, the reserve is initially near zero or slightly positive because the level premium is calibrated to be actuarially equivalent to the expected benefits over the full term. As the policy ages, and as the probability of dying increases with age, the expected future benefits grow relative to the expected future premiums, and the reserve increases. For many term policies, the reserve peaks somewhere in the middle years of the term, and then declines as the policy approaches its expiration date. You review the aggregate reserve calculation for the company's in-force block of term life policies. The calculation uses the company's current reserve basis. The 2017 Commissioner's Standard Ordinary CSO mortality table with prescribed improvement factors, a net premium reserve methodology, and the interest rates specified by the standard valuation law. You verify that the model is using the correct mortality table, the correct improvement factors, and the current in-force policy data, which was extracted from the policy administration system this morning. You verify that the model is producing results consistent with the prior quarter's results adjusted for the known changes in the in-force block. New policies issued, policies that lapsed, and policies that resulted in a death claim. The statutory reserve for the term life block is $342 million. This is approximately $1.4 million higher than the prior quarter's reserve, reflecting the net effect of new issues, lapses, claims paid, and the aging of the in-force block. You review the components of the change. New issues contributed approximately $3 million of new reserve. Lapses and surrenders released approximately $1.2 million of reserve from policies that terminated. Claims paid during the quarter were associated with approximately $800,000 of reserve that was released on settlement. The aging of the in-force block increased reserves by approximately $600,000 as existing policies moved into higher age, higher reserve years. The arithmetic checks. You note the reserve figures and their components in the quarterly reserve report. The professional opinion on reserve adequacy is a formal document required under the standard valuation law. It is signed by the appointed actuary, which is a designated role with specific legal responsibility for the reserve opinion. At your company, the appointed actuary is your manager, a fellow actuary with more seniority. Your role is to prepare the supporting documentation and calculations that the appointed actuary will review and rely upon in providing their opinion. This supporting documentation must be thorough, because the professional standards of the actuarial profession require that the appointed actuary's opinion be supported by sufficient actuarial work to satisfy a peer review. And because, if the reserves are later found to be inadequate, the documentation is the evidence of the process that was followed. The professional standards governing actuarial work are more extensive and more specific than most people outside the profession realize. The actuarial profession in the United States is governed by the American Academy of Actuaries, the Society of Actuaries for Life and Health Actuaries, and the Casualty Actuarial Society for Property and Casualty Actuaries, among other bodies. These organizations promulgate actuarial standards of practice, known as ASOPS, which are binding professional standards specifying how actuaries must approach specific types of actuarial work. ASOPS cover topics including life insurance reserving, pension plan actuarial valuations, health insurance assumptions, risk classification, catastrophe modeling, and many others. Each ASOP specifies the methods and considerations that are required or recommended for the specific type of work, the disclosures that must be made in actuarial communications, and the documentation that must be maintained. Compliance with ASOPS is not optional. A practicing actuary who produces work that does not comply with the relevant ASOPS may be subject to disciplinary action by their credentialing organization, up to and including revocation of their credentials. The requirement for actuarial communications to include specific disclosures is one of the more distinctive features of actuarial professional practice. An actuarial report must disclose the purpose of the analysis, the data used, the methods and assumptions employed, any material limitations or uncertainties in the analysis, and the scope of the actuary's work. These disclosures are intended to enable a reader of the report, including another actuary performing a peer review, to understand and evaluate the analysis. An actuarial report without adequate disclosures is not a compliant actuarial document, regardless of how accurate its numerical results may be. You are working on a preliminary draft of the actuarial memorandum that will accompany this quarter's reserve calculation. The memorandum is addressed to the appointed actuary and documents your work in sufficient detail to support their reserve opinion. You describe the data used, the enforced policy extract from the policy administration system, the date of extraction, the record count, and the validation checks performed to confirm the data's accuracy. You describe the methodology, the net premium reserve methodology, the applicable regulatory basis, and the modeling approach. You describe the assumptions, the mortality table, the improvement factors, and the interest rates. You note any significant judgments you made in the course of the calculation, and you note any areas of uncertainty or limitation that the appointed actuary should be aware of when reviewing the results. the question of professional judgment is one that runs through all actuarial work. Actuarial methods involve choices: which mortality table to use, how to project future improvements, what lapses to assume, how to model policyholder behavior under various scenarios. These choices are informed by the data and by the actuarial standards, but they are not mechanically determined by either. Two competent actuaries working with the same data and following the same standards may arrive at somewhat different conclusions, and the difference between them lies in professional judgment. The requirement to document your judgment, to disclose your assumptions, and to explain your reasoning is the profession's mechanism for making those judgments reviewable and accountable. You complete the draft memorandum for this quarter's reserve calculation and send it to your manager for review. You note in your task list that you need to follow up on the comments from the prior quarter's review, which included a request to add more detail to the section on data validation. You add that detail to the current memorandum before sending it. You have a system for incorporating review comments. You maintain a comments log for each recurring project, tracking each comment received, the response or action taken, and whether the issue was resolved. The log is not required by any standard. It is required by your own practice of doing things properly. You eat lunch at your desk, which is a habit you intend to break and have not broken. At 1:45, you review the agenda and supporting materials for the 2 o'clock product development meeting. The meeting is to discuss a new whole life insurance product that the product development team wants to launch in the 3rd quarter. Whole life insurance is fundamentally different from term life insurance in one important respect. It does not expire. A whole life policy provides a death benefit for the entire lifetime of the insured in exchange for level premiums paid for a specified period. Because the death benefit is certain to be paid at some point, the policy necessarily accumulates a cash value, a savings component that grows over time, and that represents the portion of the premiums paid that exceeds what is needed to fund the near-term mortality cost. The cash value belongs to the policyholder and can be accessed through policy loans or surrenders. Whole life insurance is therefore both an insurance product and a savings vehicle, and its pricing must account for both dimensions. The product development team has proposed a participating whole life product, meaning a product in which policyholders share in the company's profits through policy dividends. Participating whole life is one of the oldest forms of life insurance and remains common in the United States, particularly among mutual insurance companies. The dividend is not guaranteed. It is declared annually by the company based on the actual experience of the participating block relative to the conservatively priced assumptions embedded in the policy guarantees. When actual mortality is better than assumed, when actual investment returns exceed assumed, and when actual expenses are lower than assumed, the surplus is distributed to policyholders as dividends. The pricing of a participating whole life product requires establishing two sets of assumptions. The guaranteed basis, which represents the most conservative assumptions that the company commits to in the policy contract, and the illustrated basis, which represents the assumptions underlying the policy's projected dividend scale. The guaranteed basis must be conservative enough that the company can meet all policy guarantees under adverse scenarios. The illustrated basis should be realistic, based on current experience and reasonable forward-looking assumptions, and must comply with the illustration regulations promulgated by the NAIC under Actuarial Guideline 49. You arrive at the meeting with a preliminary analysis of the proposed product's financial characteristics. The product development team has specified the death benefit, the premium structure, and the target market segment. Your analysis covers the pricing implications of these specifications, the mortality assumption needed to support the price, the required investment return, the expected cash value accumulation profile, the sensitivity of the product's profitability to changes in key assumptions, and a preliminary dividend scale illustration. The meeting is attended by the product development manager, the marketing director, the chief underwriter, and yourself. The product development manager presents the product concept, a whole life product targeting the middle market, with premiums payable for 20 years, a guaranteed cash value schedule, and a competitive illustrated dividend scale. Marketing has done consumer research suggesting demand for a whole life product in this segment. Underwriting has reviewed the proposed underwriting criteria and confirmed they are workable. You present your analysis. The proposed premium structure implies a required mortality assumption of approximately 90% of the 2017 CSO table, which is consistent with the company's recent mortality experience as documented in the mortality study. The required investment return is 4.2%, which is slightly above the current portfolio yield of 4%, but within the range achievable if the new policies, premiums, are invested at current market rates. The cash value accumulation profile meets the industry standard benchmarks for competitiveness. The most significant issue you raise is the sensitivity of the product to interest rate movements. Whole life insurance products are long duration liabilities. A policy issued today may remain in force for 50 or 60 years. The investment return assumption embedded in the pricing will be compared against the actual returns earned on the company's investment portfolio over that entire period. If interest rates decline materially and remain low, the company will earn less than the assumed 4.2% on its investments, creating a drag on the product's profitability. This is not a hypothetical risk. The low interest rate environment of the 2010s created significant challenges for life insurers that had priced long duration products, assuming higher investment returns. You present a stress test showing the product's profitability under 3 interest rate scenarios: base case at 4.2%, low case at 3%, and very low case at 2%. Under the base case, the product meets the company's target return on equity. Under the low case, the return on equity falls below target but remains positive. Under the very low case, the product is expected to generate a loss on a lifetime basis. You recommend either pricing the product with a more conservative interest rate assumption, accepting a lower return on equity in the base case in exchange for more resilience in adverse scenarios, or incorporating an interest-sensitive feature such as a dividend scale that is more responsive to investment returns, reducing the risk borne by the company in low-rate environments. The product development manager asks how much more conservative the interest rate assumption would need to be to ensure a positive return on equity under the very low case scenario. You calculate this in real time, approximately 3.5%, which would require an increase in the premium of approximately 4% relative to the current proposal. The marketing director notes that a 4% premium increase would reduce the product's competitiveness in the target market. The discussion that follows is the central tension of insurance product development, the trade-off between competitive pricing and financial prudence. You do not resolve this tension. You quantify it, present it clearly, and provide the data needed for the decision to be made. The decision about what price to charge is a business decision made by the company's management with your analysis as input. Your role is to ensure that the analysis is correct and that the decision makers understand its implications. The meeting ends without a final decision on the interest rate assumption. A follow-up meeting is scheduled for next week, at which the product development team will present revised pricing after consulting with the investment department on the expected portfolio yield for new money invested in the current environment. You will prepare an updated sensitivity analysis before that meeting. After the meeting, you address the question from your colleague about stochastic modeling. This requires some explanation of the distinction between deterministic and stochastic actuarial models, which is a distinction that matters increasingly in contemporary actuarial practice. A deterministic model uses a single set of fixed assumptions to project a single set of outcomes. The reserving calculation you reviewed this morning is deterministic. You specified a single mortality table, a single interest rate, a single lapse assumption, and the model produced a single reserve figure. The deterministic approach is straightforward, computationally tractable, and easy to explain. It is also limited because it produces a single point estimate without quantifying the uncertainty around that estimate. The reserve figure produced by a deterministic model tells you the expected present value of future obligations under a specific set of assumptions. It does not tell you how much that figure might vary if the assumptions turn out to be wrong. A stochastic model replaces the fixed assumptions with probability distributions. and simulates a large number of possible future scenarios, each drawn from those distributions. Instead of a single reserve figure, the stochastic model produces a distribution of reserve figures across the simulated scenarios. This distribution allows you to ask questions like, what is the 95th percentile of the reserve distribution, meaning the amount that would be sufficient to cover claims in 95% of simulated scenarios? What is the probability that claims exceed the current reserve by more than 10%? How does the distribution of outcomes change if the mortality improvement assumption is increased or decreased? The colleague's question is about the implementation of a stochastic interest rate model for a new product line. Interest rates are particularly well suited to stochastic modeling because they are continuous, observable, and have well-documented statistical properties that can be captured in mathematical models. Several interest rate models are commonly used in insurance actuarial work. The Cox and Jersall-Ross model, developed in 1985, is a single-factor model that describes interest rates as a mean-reverting process. Rates tend to drift back toward a long-term mean, with random fluctuations around the mean-reverting drift. The Hull-White model extends this framework to fit the current term structure of interest rates. More complex multi-factor models capture the behavior of rates at different maturities, allowing the model to generate realistic yield curve shapes rather than just parallel shifts. You draft a response to your colleague, explaining the choice between these models for the specific application they have in mind. The product line in question has relatively short durations, 5 to 10 years of cash flows, and the primary concern is the sensitivity of the product's margins to interest rate movements rather than the absolute level of reserves. For this purpose, you recommend a relatively simple approach: a single-factor mean-reverting model calibrated to historical interest rate data with a sufficient number of scenarios, typically at least 1,000, to produce stable percentile estimates. The computational cost of running 1,000 simulations of the pricing model is manageable with current computing resources. The additional insight from a more complex multi-factor model would not, in your judgment, be proportionate to the additional implementation effort for this specific application. You note that the model should be validated before it is used in production. The simulated interest rate distributions should be compared against historical data to confirm the model is producing plausible behavior, and the model's outputs should be checked for internal consistency. For example, confirming that no arbitrage conditions are satisfied. Model validation is a requirement under the actuarial standards governing model governance, and is also simply good practice. A model that has not been validated is a model whose outputs should not be relied upon, regardless of how elegant the underlying mathematics may be. The work we have described so far has been in the context of life insurance, which is your primary practice area. But the actuarial profession extends well beyond life insurance, and a 2-hour description of actuarial work would be incomplete without a visit to pension actuarial work, which occupies a substantial portion of the profession and involves a distinct set of concepts and calculations. A defined benefit pension plan is an arrangement in which an employer promises to pay retiring employees a pension benefit determined by a formula, typically based on years of service and final or average salary. The plan accumulates assets through contributions from the employer and, in some plans, from employees, and pays benefits to retirees from those assets. The actuary's role in a defined benefit plan is to determine how much the employer must contribute each year to keep the plan adequately funded, and to calculate the plan's liabilities for financial reporting purposes. The pension actuarial valuation is an annual calculation that determines the plan's funded status. The relationship between the plan's assets and its liabilities. The liability is the present value of all future pension benefits that have been earned by current and former employees, calculated using the assumed discount rate, the assumed mortality, rates for plan participants, and assumptions about future salary increases, rates of employee turnover, and rates of disability. The funded status is the ratio of assets to liabilities. A funded ratio above 100% means the plan has more assets than its measured liabilities, which is a desirable but not universal condition. The discount rate used to calculate pension liabilities is one of the most consequential and contentious assumptions in pension actuarial work. For corporate pension plans in the United States, the accounting discount rate is required by GAAP to reflect the yield on high-quality corporate bonds, with durations matching the plan's liability cash flows. When interest rates fall, the discount rate falls, the present value of future liabilities rises, and the plan's reported funded ratio falls, even if nothing else has changed. This creates a peculiar situation in which a plan can move from overfunded to significantly underfunded in a short period, simply due to interest rate movements, without any change in the plan's benefits, contributions, or investment performance. Many corporate pension sponsors have found this volatility uncomfortable and have moved to reduce or eliminate their defined benefit obligations as a result. The mortality assumption in pension work is the mirror image of the mortality assumption in life insurance. For a life insurer, higher mortality is adverse. People die sooner than expected, and death benefits are paid earlier and more often. For a pension plan, lower mortality is adverse. People live longer than expected, and pensions are paid for more years. The emergence of longevity risk, the risk that a population lives longer than expected, has become one of the dominant themes in pension actuarial work over the past 2 decades, as life expectancy has continued to increase, and as the pension obligations of both public and private plans have grown in proportion. The Society of Actuaries publishes the RP, or retirement plans, mortality tables for use in pension valuations. The most recent version, RP-2014, with the MP-2021 Mortality Improvement Scale, reflects the most current available data on mortality trends for the retirement age population. These tables show notably higher life expectancies than earlier tables, reflecting the continued improvement in survival rates at older ages observed in recent decades. Using an older, less conservative mortality table understates pension liabilities because it assumes participants will die earlier and collect fewer years of benefits than current experience suggests. The actuarial standards require that mortality assumptions be reasonable, which means they must reflect current and expected future experience. Using tables that are known to understate life expectancy is not compliant with the standards, regardless of the cost implications for the plan sponsor. Property and casualty insurance, abbreviated P&C, is the other major branch of insurance, covering the things that life and health insurance do not: your car, your house, your business, and your liability for harm caused to others. P&C actuarial work shares the broad framework of life actuarial work, using data, models, and professional judgment to quantify risk. But it differs in important ways that have shaped the development of distinct methods and a separate credentialing track. The most fundamental difference between life and P&C insurance is the nature of the risk. Life insurance risks are well behaved in a statistical sense. Mortality rates are relatively stable and predictable from year to year. The statistical law of large numbers operates effectively for large portfolios of life insurance policies, and the tail of the loss distribution is bounded by the face amount of the policy. P&C risks are less well behaved. They are subject to catastrophic events such as hurricanes, earthquakes, and wildfires that can produce losses orders of magnitude larger than the typical loss. They are subject to social and legal trends that can cause claim costs to increase rapidly and unpredictably. And the tail of the loss distribution for liability insurance, in particular, is effectively unbounded. P&C actuarial reserving involves estimating the incurred, but not yet reported, IBNR liability, the amount the company expects to ultimately pay for losses that have already occurred, but that have not yet been fully reported or settled. An insurance company that writes automobile liability insurance will receive claims from accidents that occurred months or years ago, because the legal process of settling a liability claim can take years. The reserves must reflect the company's best estimate of what those claims will ultimately cost, including claims that have not yet been reported at all. Estimating IBNR liabilities requires analyzing the historical patterns by which claims develop over time, a process called loss development or chain ladder analysis. Chain ladder analysis uses a triangle of data: cumulative paid losses organized by the year the claim was incurred, the accident year, and the number of months of development since the accident year. The diagonals of the triangle show how claims paid in a given accident year have grown with each successive calendar year of development. By calculating development factors from the historical diagonals and projecting the most recent diagonal forward, the actuary estimates the ultimate losses for each accident year. This method has been the workhorse of P&C reserving for decades and is well understood. Its limitations are also well understood. It assumes that future development will follow historical patterns, which may not be true if there have been changes in claims handling, coverage terms, or the legal environment. Catastrophe modeling is the P&C actuarial specialty most directly relevant to the most extreme risks. A catastrophe model is a computational simulation of a natural peril, such as a hurricane or an earthquake, that combines meteorological or geological models of the event with engineering models of building vulnerability and insurance models of policy coverage to estimate the insured losses from events of specified severity. The output of a catastrophe model is a distribution of potential losses, not just the expected loss, but the full range of possible outcomes, including the probability of extreme events. The probable maximum loss, or PML, is a commonly reported statistic from catastrophe models. The loss that would be expected to be exceeded with a specified probability, such as once in 250 years in a given year. You are not a P&C actuary and do not work with catastrophe models in your daily practice, but you follow developments in the field because the methods developed in P&C work have increasingly influenced life actuarial practice, particularly in the areas of stress testing, economic capital modeling, and enterprise risk management. The boundary between the two branches of the profession has become more permeable over the past 2 decades, as the risk management frameworks used by insurance companies have evolved toward integrated, enterprise-wide approaches. In the late afternoon, you turn to the section of your work that is furthest from the traditional actuarial methods we have described so far. Economic capital modeling and enterprise risk management. Economic capital is the amount of capital an insurance company would need to hold to remain solvent under a specified adverse scenario, defined at a specified confidence level. The standard approach, aligned with the Solvency II regulatory framework used in the European Union, and with the risk-based capital frameworks used in various forms elsewhere, is to calculate the 99.5 percentile of the 1-year loss distribution, the loss that would be exceeded with a probability of 0.5% in any given year, or equivalently, the loss associated with a 1 in 200 year event. A company that holds capital equal to its 99.5 percentile loss is, in principle, able to withstand a 1 in 200 year adverse outcome without becoming insolvent. The calculation of the 99.5 percentile loss requires modeling all of the risks that could cause the company to lose money: mortality risk, longevity risk, morbidity risk, lapse risk, interest rate risk, credit risk, equity risk, and operational risk. Each risk type has its own distribution of potential outcomes, and the total capital requirement depends not only on the individual risk distributions, but on the correlations between them. Two risks that tend to occur together, such as credit spreads widening and equity prices falling during a financial crisis, require more combined capital than two risks that are independent, because when they occur simultaneously, the total loss is larger. You are working on the annual update to the company's economic capital model. The update involves refreshing the calibration of each risk module using the most recent historical data, reviewing the correlation assumptions between risk types, and running the full model to generate the updated capital requirement. The model is implemented in a combination of a statistical computing environment and a spreadsheet-based aggregation tool. You are reviewing the mortality risk module specifically because the mortality study results from this morning have implications for the calibration of the mortality shock used in the economic capital calculation. The mortality shock in the economic capital model is the adverse deviation in mortality that the company must be able to withstand at the 99.5 percentile confidence level. It is expressed as a percentage increase in the base mortality rates. A mortality shock of 15% means that in the adverse scenario, mortality rates are 15% higher than the base assumption, meaning 15% more deaths than expected. The question of what mortality shock is appropriate at the 99.5 percentile is an empirical question, answered by analyzing the historical distribution of actual mortality experience relative to expected. In a year like 2020, when COVID-19 caused substantial excess mortality, actual mortality across much of the developed world exceeded expected by a significant margin. Calibrating the mortality shock to the 99.5 percentile requires having sufficient historical data to estimate the tail of the distribution. And the COVID-19 experience has provided, at considerable human cost, a new data point for this calibration. You update the mortality shock parameter in the economic capital model to reflect a recalibration that incorporates the 2020 through 2022 excess mortality experience. The updated shock is modestly higher than the prior calibration, reflecting the additional tail risk evidence from the pandemic period. The effect on the total economic capital requirement is an increase of approximately 3%, which is a meaningful but not dramatic change. You document the recalibration and the rationale for the parameter update in the model documentation. Enterprise Risk Management, ERM, is the broader organizational framework within which economic capital modeling sits. ERM involves identifying all of the risks facing the organization, assessing their likelihood and potential impact, developing strategies to manage or mitigate them, and monitoring their evolution over time. The actuary's role in ERM is both quantitative, providing the models and metrics that measure risk, and qualitative, participating in the risk governance processes that determine how the organization responds to the risks it faces. You serve on the company's risk committee, which meets monthly to review the risk dashboard, a summary of the company's current risk, exposures relative to its risk appetite limits. The risk appetite is the amount of risk the company's board of directors has determined is acceptable, expressed in terms of the metrics used in the economic capital model. A company operating within its risk appetite limits is managing its risks within the bounds set by its governance structure. A company that exceeds a risk appetite limit is required to develop and implement a remediation plan. Your role on the risk committee is to present the actuarial view of mortality, longevity, and lapse risk, and to explain the implications of changes in those risks for the company's capital position. In the late afternoon, after the more intense analytical work is complete, you spend time on professional development. This takes two forms: continuing education to maintain your credentials, and mentoring a junior colleague who is currently working through the actuarial examination process. Continuing education is required for credentialed actuaries. Fellows of the Society of Actuaries are required to complete 30 hours of continuing education per year, including at least 3 hours in professionalism, which covers the Actuarial Code of Ethics, the Actuarial Standards of Practice, and related topics. The professionalism requirement reflects the profession's understanding that technical competence is necessary, but not sufficient for responsible actuarial practice. An actuary must also understand the professional obligations that govern how that competence is applied. The Actuarial Code of Ethics contains 8 canons. The first canon requires actuaries to act honestly, with integrity and competence, and in a manner that fulfills the profession's responsibility to the public. The second requires actuaries to perform actuarial services only when qualified to do so. The third requires actuaries to ensure that actuarial services performed under their direction meet applicable standards. The fourth requires actuaries to not engage in any professional conduct involving dishonesty, fraud, deceit, or misrepresentation. The fifth requires actuaries to be fair and reasonable in communications and not obscure or mislead. The sixth requires actuaries to not perform services in a manner that violates professional independence. The seventh requires actuaries to disclose potential conflicts of interest. The eighth requires actuaries to not engage in any conduct that brings the profession into disrepute. These 8 canons are not unusual in the context of professional ethics. What distinguishes the actuarial code from some other professional codes is the specific requirement of independence. When an actuary provides a professional opinion, particularly when that opinion is required by law or regulation, the opinion must reflect the actuary's honest professional judgment, not the judgment preferred by the client or employer. This creates a potential tension because actuaries are typically employed by the entities whose work they are opining on, and the organizations that pay their salaries have interests that may not always align perfectly with a conservative, independent actuarial opinion. The professional standards and the code of ethics exist precisely to maintain the independence of the actuarial opinion in the face of this tension. An appointed actuary who provides a reserve opinion that they know to be deficient because their employer wants to report lower liabilities is in violation of the code of ethics, regardless of any pressure they may have faced. Your junior colleague is preparing for Exam 7, which covers principles of actuarial science and life insurance. The actuarial examination sequence begins with preliminary exams that test mathematics, probability, financial mathematics, and statistics. These exams are jointly administered by the Society of Actuaries and the Casualty Actuarial Society, and are required for both practice areas. The fellowship level exams that follow are specific to the practice area. Life, health, or PNC, each exam takes several hours and covers a substantial body of material. The preparation time for each exam is typically 3 to 6 months of serious study. Your colleague is struggling with the section on life contingencies, specifically the calculation of net premiums and reserves using the continuous and discrete formulations of the present value of future benefits. This is a topic that requires facility with both probability theory and the technical notation used in actuarial mathematics, and it takes most candidates time to develop this facility. You spend 30 minutes working through several practice problems with your colleague, focusing on setting up the calculations correctly before attempting the arithmetic. The conceptual framework for these problems is always the same. The present value of a random variable representing future benefits, where the randomness comes from the future lifetime of the insured. If you understand the framework, the specific calculations are mechanical applications of it. If you do not understand the framework, the calculations are a confusing collection of formulas with no apparent organizing logic. You help your colleague see the framework. Whether they can reproduce it independently on an exam in 8 weeks is a different question, but the framework is now visible to them, which is progress. Late in the afternoon, you address the 3 emails that have been waiting all day. They are not routine administrative emails. They are substantive questions that require actuarial judgment to answer, and they represent a significant part of the work that does not appear in any project plan or task list. The continuous, informal communication that connects the actuarial function to the rest of the organization. The first email is from the Chief Financial Officer, asking for an explanation of why the statutory reserve increased this quarter when the number of in-force policies decreased. This is a reasonable question from a non-actuary, and a question that requires a careful answer. The reserve increased despite fewer policies in force because the policies that remained are, on average, older and therefore have higher reserves per policy than the policies that lapsed. A 35-year-old policyholder in the 5th year of a 20-year term policy has a higher reserve associated with their policy than a 25-year-old policyholder in the same policy, because the older policyholder is closer to the ages where mortality rates rise steeply, and the expected future benefits are larger relative to the expected future premiums. When younger policies lapse at a higher rate than older ones, the average reserve per policy increases even as the total count decreases. You write a response explaining this with a simple numerical illustration using 2 hypothetical policies to make the concept concrete. The response is 6 paragraphs, written in plain English, with no actuarial notation. The CFO is a sophisticated financial professional who does not need actuarial notation. They need the concept explained clearly and the numbers to add up. You provide both. The second email is from the legal department, asking whether a specific policy wording ambiguity could result in a material financial exposure for the company. The wording in question relates to the definition of total disability in a group disability product. Legal has identified that the current wording could be interpreted in a way that broadens the scope of covered disabilities beyond what was intended at pricing. Your task is to estimate the financial exposure if the broader interpretation were to be applied. You pull the relevant data from the policy administration system, the in-force count for this product, the benefit amounts, the current reserve. You estimate the incremental liability if the disability incidence assumption were increased by the amount that the broader interpretation might imply, based on the range of disabilities that the broader wording could cover. The incremental liability is approximately $4.2 million, which you flag as a material but manageable exposure. You communicate this estimate to legal with appropriate caveats. The estimate is based on assumptions about how the broader interpretation would affect disability incidence, and the actual exposure would depend on how claimants and courts interpret the wording. The estimate is a point estimate around which there is meaningful uncertainty. You state this explicitly. The third email is from the state insurance regulator, requesting a response to a data call on the company's mortality experience for a recent calendar year. The data call is a standard regulatory information request, asking for aggregate mortality data organized by age, sex, and policy type. You have the data from the mortality study. You organize it in the format specified by the regulator's request, add the required disclosures and certifications, and draft a cover letter explaining the data, and noting any features of the company's experience that might require context for interpretation. The cover letter and data are reviewed by your manager before they are sent. Regulatory submissions go out under dual review as a matter of policy. The communication skills required for these three responses are as important as the technical skills required to produce the underlying analyses. An actuarial result that cannot be communicated effectively is an actuarial result that cannot influence decisions. Effective communication to non-actuarial audiences requires the ability to identify which aspects of the analysis are essential for the recipient's purposes and which are technical details that, while important for the actuary's own understanding, would add confusion rather than clarity to the communication. It requires the ability to quantify uncertainty in terms that a non-specialist can understand and act on, and it requires the discipline to make the distinction between what the analysis shows and what it does not show, because an actuary who overstates the precision or the certainty of their conclusions is providing a disservice to the people relying on those conclusions. At 6 p.m, you review the day's work and prepare for tomorrow. The mortality study is progressing and will be complete in approximately 2 more weeks. The reserving calculation is on track for Friday. The product development meeting has generated follow-up work that will occupy several sessions next week. The economic capital model update is in progress. The 3 emails have been answered. Your colleague is slightly less confused about net premium reserves than they were this morning. This is a satisfactory day's work. You update your task list for tomorrow. Continue the mortality study supplementary analyses, particularly the investigation of the adverse experience in the 70 to 79 age band. Complete the first draft of the reserving memorandum. Prepare the updated interest rate sensitivity analysis for the product development follow-up meeting. Respond to any comments from your manager on the reserving memorandum draft. These tasks will occupy most of tomorrow. You will also almost certainly have 3 more emails requiring substantive responses. Before closing your laptop, you spend a few minutes reading a recent paper on mortality modeling that appeared in the North American Actuarial Journal. The paper concerns the use of machine learning methods to improve the prediction of individual mortality risk from underwriting data. This is a topic of genuine professional interest. If machine learning methods can extract more predictive information from the same underwriting data than traditional methods, they could improve the accuracy of mortality risk classification, and therefore the accuracy of pricing. The paper's results are promising, but the sample size is limited, and the authors acknowledge that the performance advantage of the machine learning approach relative to traditional methods is modest at most age ranges and most coverage amounts. You note the paper's conclusions in your reading log, a simple text file where you record summaries of actuarial literature you have read, organized by topic. The reading log is not required. It is the professional equivalent of the maintenance log you keep for the office printer. If you also maintain the office printer, which you do not, because you are an actuary, the reading log has entries going back 6 years. The entries from 6 years ago reflect the preoccupations of a more junior actuary. They are focused on technical methods and examination material. The entries from more recent years reflect a broader range of concerns: professional standards, communications, regulatory developments, emerging risks. This shift reflects the natural evolution of actuarial practice as experience accumulates. The technical foundation becomes more solid and more automatic, and the professional attention expands to the judgment, communication, and governance dimensions of the work that cannot be mastered from examination syllabi alone. You close your laptop. You turn off the desk light. The office is quiet in the way that offices are quiet at 6 in the evening, with the ambient hum of the building's climate control system and the distant sound of the elevator. The mortality study is still in progress. The reserve model is still running its scheduled overnight recalculation. The economic capital model is still waiting for its final run. These things will all be there in the morning. They are not done yet. They do not need to be done tonight. You leave. You have completed a day as an actuary. During this day, you reviewed the progress of a mortality study, identified a statistically significant adverse trend in one age band, and flagged it for further investigation. You reviewed the pricing assumptions for a term life product and identified 3 assumptions warranting revision: the year 1 lapse rate, the per policy administrative expense, and, pending further analysis, possibly the interest rate assumption. You completed the quarterly reserve calculation for the term life block, producing a statutory reserve of $342 million, and drafted the actuarial memorandum documenting the methods and assumptions. You attended a product development meeting for a new whole life product and raised the interest rate sensitivity issue, presenting a stress test across 3 scenarios. You responded to a stochastic modeling question with a recommendation for a single factor, mean reverting interest rate model. You updated the mortality shock parameter in the economic capital model. You spent 30 minutes working through net premium reserve calculations with a junior colleague. You responded to 3 substantive emails from the chief financial officer, legal, and the state insurance regulator. You read a paper on machine learning methods in mortality modeling and logged the summary in your reading log. The people who bought life insurance policies today are not thinking about any of this. They are thinking about the coverage amount and the premium, and whether their beneficiary designation is current. They are not thinking about the A/E ratio analysis that calibrated the mortality assumption used to price their policy. They are not thinking about the net premium reserve that the actuary calculated this quarter to represent the present value of the obligations the company has undertaken to them. They are not thinking about the economic capital model that determined how much surplus the company holds as a buffer against the possibility that too many of them die sooner than expected. All of these things are happening at a level of the insurance system that is entirely invisible to the people it protects. And they are happening because actuaries do this work every day in offices that look like other offices, in front of computers that look like other computers, with spreadsheets that contain numbers that mean something very specific about the future, expressed as a probability. Edmund Halley, who published the first reasonably accurate life table in 1693 based on mortality data from the city of Breslau, did not know that he was founding a profession. He was an astronomer who was also interested in mortality statistics, in the way that people in the 17th century were interested in many things, and made contributions across fields that are now separate disciplines. The mortality table he constructed used data on 2,024 deaths recorded over 5 years in Breslau, a relatively modest data set by modern standards, and from it he derived life expectancies at each age that were surprisingly accurate given the data limitations. He noted in the paper accompanying the table that the table could be used to price life annuities, which are financial products that pay a fixed amount per year for as long as the purchaser lives. He was right. The insurance industry has been using this insight for more than 300 years. The life table you used today has its roots in Halley's table, and in the tables of every actuary who worked in the intervening centuries, refining the methods, improving the data, extending the framework to accommodate the full complexity of modern insurance products. Mortality study you are completing is a contribution to this 300-year-long empirical project. Another few years of data from another insurance company's experience, added to the aggregate understanding of how long people live and what affects how long they live. It will not be remembered. It will not be attributed. It will be used, incorporated into the assumptions of products that will be sold to people who will not think about where the numbers came from. This is the correct outcome. The work is done. The numbers are right. The people are protected. Good night. The reserve model will complete its overnight recalculation by 4 in the morning. The results will be waiting when you arrive.